The outbreak of the COVID-19 pandemic sent shockwaves throughout the world, and China, which was the epicenter of the virus's initial spread, was not spared. While it is undeniable that the pandemic had a profound impact on China's economy, it may be premature to declare the end of China's economic superpower status. In this video, we will explore the effects of COVID-19 on China's economy and the factors that suggest it's more of a temporary setback than a permanent decline. The first few months of the pandemic in China were marked by lockdowns, travel restrictions, and a significant drop in economic activity. It's estimated that China's economy contracted by around 6.8% in the first quarter of 2020. Factories shuttered, global supply chains were disrupted, and domestic consumption plummeted as people stayed home to curb the virus's spread. China's brutal domestic handling of the pandemic saw the country endure unpredictable lockdowns and arbitrary enforcement of different rules and standards. This seems to have led many Chinese households to anticipate more challenging times ahead, rather than spend the savings they set aside during the pandemic, in contrast to their counterparts in the West. The result is economic long COVID on a scale unlike anything seen elsewhere. Together with record high youth unemployment and declining fertility rates, as well as memories still fresh of last year's social unrest on the streets, Chinese public sentiment is distinctly downbeat. Stringent public health measures were in place for almost 3 years in China. The economic activities of enterprises, especially small and micro enterprises, were severely impacted. The costs of continuing this stringent policy were enormous. Over the past 3 years, the tight public health measures and lockdown have had a large negative impact on growth in China. China's economic recovery since lifting its zero COVID policy appears to be a flop. Data in the last month reveals record high youth unemployment and shrinking credit demand. E-commerce companies didn't release total sales numbers during a significant shopping day on Sunday, suggesting low consumer spending. Small businesses are struggling, and the government is in crisis mode, seeking answers from business leaders and economists for a problem mainly of its own making. Even before the pandemic, the Chinese economy showed signs of slowing down, but today, public confidence is the most significant single factor in the faltering economy. After the last few years, people are unwilling to spend and unwilling to make even slightly risky investments. COVID-19 lockdowns tested ordinary household savings through income losses, delivery costs, and price gouging as essential goods ran short. In 2022, household savings rose by 80% from the previous year. That money isn't being spent now. Compared to those in Western countries, small and medium-sized businesses in China received little financial aid, despite more severe restrictions. And while the Chinese government has done its best to pretend that the lockdowns and the wave of mass infection after the zero COVID policy was lifted never happened, they are burned into public memory. Although people may not fear lockdowns at this point, even amid another rise in COVID-19 cases in China, they are much more aware of the power of the government to radically alter their lives. New risks to the Chinese economy, notably the Omicron variant, could spell trouble for China's economy in 2022. Small surges in infections prompted stringent lockdowns in the country's largest industrial cities, grinding supply chains to a halt. Added concerns over debt and a real estate bust point to a slowdown in China's rapid recovery. The IMF cut its forecast for China's 2022 GDP growth based on expectations the zero COVID policy will cause increased restrictions on business activity and that there will be protracted financial stress among property developers. China's zero COVID policy has helped mitigate virus spread, and the country continues to report a low official death toll. The country is also reportedly to be heavily vaccinated, with nearly 86% of the total population receiving 2 doses. However, with little natural immunity and far less productive vaccines, China is opting to maintain strict lockdowns in the face of more minor outbreaks. Weakened Chinese production poses a major setback for for businesses hoping to unclog supply chain bottlenecks that have plagued the global economic recovery. One of the reasons for Chinese emergence as an economic superpower was its deep integration into the global economy. As the pandemic disrupted economies worldwide, the repercussions were felt far beyond China's borders. This interconnectedness has both positive and negative implications. On one hand, China's export-driven economy suffered as demand waned globally. On the other hand, as the world recovered, China was poised to benefit from renewed international trade. Industrial production fell 2.9% last month from a year earlier, reversing a 5% gain in March. This marks the worst contraction in industrial production since February 2020, when China's economy came to a near standstill during the initial coronavirus outbreak. Unemployment also surged to the second highest level on record. The urban jobless rate hit 6.1% in April, up from 5.8% in March, which was already at a 21-month high. The only time China's jobless rate was higher was in February 2020. Young people have been finding it especially hard to find jobs, the data showed, with the unemployment rate for those between 16 and 24 years of age rising to 18.2%, the highest ever. Rising unemployment is a warning sign for the ruling Communist Party, given the risk of social and political instability. All of this has left people in China scared to take chances with their money. Ordinarily, that fear might lead them to funnel their money back into real estate, the main driver of the Chinese economy in the last 2 decades, and a sector that makes up around 70% of Chinese investment. But with the ongoing property crisis, that isn't an appealing option, and the government is still propping up prices to reassure the middle class. Some investors have turned to gold and jade as alternatives. China's ongoing urbanization and population growth have continuously driven demand for housing. The pandemic, rather than slowing this trend, accelerated it. The crisis made people living in less urbanized areas consider relocating to bigger cities in search of better healthcare, job opportunities, and improved living conditions. This influx of people further strained the housing market. Historically, real estate in China has been a preferred form of investment. COVID-19 increased uncertainty in financial markets, leading more individuals and investors to view real estate as a safer and more lucrative option. As a result, property purchases, often for investment purposes rather than occupation, surged during the pandemic. The housing crisis in China has severe implications for ordinary citizens. Rapidly rising housing prices have made it increasingly challenging for young professionals and families to purchase homes. Many individuals are forced to live in smaller, more expensive apartments or face longer commutes from more affordable suburbs. China's government is likely to respond to the economic downturn in a familiar way, with a massive stimulus package, including more support for the real estate sector. As economist Michael Pettis pointed out, that is not a great solution. It could only reinforce the problem. The government has repeatedly tried to reform the real estate sector, but it keeps backing off measures such as property taxes after public complaints. China's economy was off to a solid start in 2022, recording 4.8% growth for the first quarter. But Beijing's efforts to curb its worst COVID outbreak in 2 years have dealt a hefty blow to activity since March, and economists now expect GDP to shrink this quarter. After the outbreak of COVID-19 in December 2019, the average economic growth of 6% suddenly dropped to 2.2% in 2020. The unprecedented pandemic hindered consumer demand, production, investment, and international trade. In 2021, growth bounced back to 8.4% from a relatively shallow base in 2020. In 2022, with the reoccurrence of the COVID-19 pandemic and the strict zero-COVID policy, growth dropped into the 3% range. To remove large fluctuations in GDP growth during the COVID period, we calculated a 3-year moving average of economic growth. As shown in Figure 1, the 3-year moving average shows a continuous downward trend in the pre-pandemic period, followed by a sharp decrease during the pandemic, 2019 to 2022. In early April, the government did announce that it will embark on new reforms to improve the allocation of markets for various factors of production, including labor, land, capital, technology, and data. This, in turn, could lead to further structural reforms in land management, household registration, the financial system, and the rules on research and development. If done properly, all this might unleash new growth and prosperity in China. Make sure to let us know your thoughts down below. Subscribe to the channel as a sacrifice to the gods of the algorithm. Thanks for watching, and see you next time.